Hey everyone, my name is Geoff and I'm the head of marketing here at A2X, e-commerce accounting automation software for the world's leading Shopify, Amazon, eBay, Etsy, and Walmart sellers, as well as our accounting partners. And speaking of partners, I'm joined today by Mani Duggal, CEO of ZonKeepers, an Australian-based bookkeeping, tax, and multi-channel advisory firm that specializes in working with e-commerce sellers. And in this video, Mani is going to share his expertise on a really important topic for fashion brands, particularly those that sell online, which is the relationship between cash flow and inventory. So stick around because we're going to get into the weeds. Mani, I just want to say thanks so much for joining me. And if you can, do you mind providing an overview of the types of clients that ZonKeepers typically works with?
Absolutely. Thanks. First of all, thanks, Geoff, for and A2X for having me on the cast today. And just a bit about ZonKeepers and who we are. We are a full-service accounting firm, essentially, where we provide, as you mentioned, cross-border tax, multi-channel advisory, bookkeeping, just name it. And what we have seen is in the last year or so, we have actually accumulated almost 20 plus fashion clients, fashion businesses in our portfolio, and we see so much data using A2X and other tools, and I guess I'm here to share some of that knowledge with you today. Yeah,
fantastic. Well, thanks so much for joining us. If you do want to get in touch with ZonKeepers, we're going to put their link in the description below, and then you could just reach out to Mani and team. So Mani, let's dive into today's topic, which is the relationship between cash flow and inventory, particularly for fashion brands. At the highest of levels, can you talk to us a little bit about what that relationship actually looks like in practice?
Absolutely. So I would define cash flow as, cash flow represents money moving in and out of the business, while inventory is the stock of goods. And now buying inventory uses cash, and it's generally tied up until the goods are sold. And then you've got your holding costs such as warehousing, markdowns, insurances. And once that inventory gets sold is when that's then converts back to cash. And what's the variable over here is the speed, essentially how quickly, the sales timing and the discounts and everything else. There's multiple variables which we can elaborate into further. Yeah.
Totally makes sense. But I would imagine that fashion brands in particular experience some unique challenges as it relates to their cash flow and inventory. Do you mind elaborating on those, please?
Sure, and that's exactly right. Just like every other business, fashion brands have got their own unique challenges. The top one, I would say, the first one would be the seasonal trends. And what I mean by the seasonal trends is essentially keeping up with the fast-moving demand. How do you respond to that? And how do you keep up with the cash which is required to respond to those demands?
Specifically as it relates to acquiring inventory to be able to meet them, right?
That is correct. That's exactly right. And then following the seasonal trends, of course, that creates what I call it as the next variable, which is the production cycles. And if there's long production cycles, then obviously you've got your raw materials, you've got cash tied up for extended periods, and essentially depending on your suppliers, you may have bulk orders, and then again it locks in a significant cash on this unsold goods, which eventually will turn into cash, but it's that time period where it's still locked in.
So Mani, you work with tons of fashion brands, as mentioned previously, and you chat with them about the importance of understanding the relationship between their cash flow and their inventory management all the time, I would imagine. Do you mind telling us why it's so important for them to understand the relationship between those two things?
Sure. Fashion brands in general must walk a fine line, and that's investing in enough inventory to meet the demands and trends while ensuring that the cash doesn't get tied up in the unsold stock. And good cash flow and inventory management unlocks the stability, flexibility, and the growth potential.
Nice. Because I would imagine if you have cash flow locked up in unsold inventory, you can't spend as much on advertising and getting your product in front of customers, and the
It's a
downstream
chain effect.
impact.
Exactly.
Yeah, 100%. So Manny, as a practice that works with quite a bit of fashion brands, I'm sure that you and your team have really good instincts for when one of your clients' cash flows might be stuck in inventory. What are some of the warning signs that you see, or in more Gen Z terminology, some of the red flags?
Yeah, no, absolutely. I'll approach this question with the assumption that fashion brands run accrual accounting. If they're not, they should be doing it, because cash accounting is the death of the inventory business. So now, accrual accounting, without going deep into the whole accounting side of it, essentially, in short, where goods for purchase, essentially like materials, buttons, fabric, everything goes into a raw materials account. The production runs take place, and then the raw materials get converted into sellable inventory, and then are converted to cost of goods sold as they are sold. Rather than cash accounting, where materials purchased are straight going into cost of goods sold, and there's absolutely no visibility into your, the relationship between your revenue and the cost and the sale and the expenses, essentially, or the COGS. Yeah, and that's exactly the reason why accrual accounting is the gold standard for inventory-based brands, and it ensures the COGS get recognized in the same period and allows you to analyze it as you move forward as to how is the business performing in terms of the growth of the sales and its related correlation with its other expenses. Yeah, let's go back to your question, which was the warning signs. Inventory value on your balance sheet is the first one. If you monitor your inventory monthly, weekly, however you do, and if you see that the stock levels are increasing, but the sales don't keep pace, that indicates that the cash is tied up in unsold goods. That's red flag number one. Second one is the margins. And that generally happens in the fashion industry when you start going with many discounts, markdowns, flash sales, so promotions just to keep up the just to keep the momentum going. However, the silent killer behind that is actually the low margins. Now, it's okay. We can go into this at a later stage when it's a slow-moving stock and you need to get rid of it. That's a whole separate issue on its own. But again, the red flag over here is that means that you have overstocked. I'll wrap this question with one really powerful ratio which we get all our clients to monitor, and that's the inventory turnover ratio. It's generally calculated as cost of goods sold divided by the average inventory. And what the business owners should be monitoring is if it's falling, so that means if turnover is slowing down, it's a sign that inventory is sitting on the shelves for longer periods of time, and hence the cash conversion cycle is obviously very poor, and cash won't be available for to meet the as we said earlier, the demands and the trends.
Yeah, that totally makes sense. I would add, or maybe I'm just being cheeky, but warning sign 0 seems like it's if you're doing cash counting.
Something which we discuss with many of our fashion brands which on board with us and are actually doing unfortunately cash come to us from non-e-commerce accountants, and when we start elaborating or when we start discussing concepts on accrual accounting, you just see this bulb light up and go, wow, why didn't anyone tell me about this?
Totally makes sense. So Manny, arguably one of the most overused maxims in small business, overused but quite relevant, especially as it relates to fashion brands, is that cash flow is the number one killer of a small business. And I would imagine that this is especially true for fashion brands, given that they spend a significant amount of inventory that they might not see the cash back on that over an extended period of time. So I would imagine that you really need to understand that relationship between cash flow and inventory. But from the perspective of an accounting practice that works with these types of businesses. Do you mind talking to me about that relationship and why it's so important for people to understand it conceptually?
Geoff, cash is king. I can probably end the statement over there, but I'll elaborate. It, generally, this is exactly I mean, you will hear this frequently in the news as well, that, fashion brands have gone bust just because they were not able to meet the demand or respond to a trend. And that's because the inventory was tied up, but it was tied up in the wrong place. So, for example, summer brand, and then we are now at winter, and then they've got this unsold stock which hasn't moved. And what's the unsold stock? It's your cash. It's your tied up cash. So not having, and this is the relationship. If you don't get this right, this is a matter of life and death of a business.
So Mani, let's get into a really important component, which is visibility, right? For you to be able to understand if cash flow is stuck in inventory, and you need that level of visibility into your financials. Can you walk us through the ideal bookkeeping setup that would enable that level of visibility?
Sure, absolutely, Geoff. So as I mentioned previously, that accrual accounting is the gold standard for inventory-based businesses. So if you're not using accrual basis, stop now and talk to an e-commerce accountant. Call me, exactly. And let's help you get on the accrual basis. Now, why does it matter? That's the question over here. Why does accrual basis of accounting matter? Again, won't go deep into the accounting concept, but the principle behind accrual accounting is to match the revenue earned against the expenses in that period. I'll give you an example which will make it slightly more clear. So let's say if we are accounting on a cash basis and we purchase, say, $100,000 worth of stock in June, and we receive it by, say, end of June, and we start selling in July. So we've got this massive outlay of $100,000 in June. And let's say we didn't have any sales in June because we didn't have any stock. So zero profit, zero sales, $100,000 in COG expense, and then hence $100,000 in loss. Now, July onwards, we started selling, and we've got sales of, say, let's say 30,000 coming in July, August, every month, let's say 30, right? But guess what? We're making profits of 30,000 each month because the COGS the full COGS was recognized in June. You see how there is no correlation, and that profit figure doesn't actually make sense. That's not a true profit because you're not able to match the related expenses and earnings. So that's where the magic of or the power of accrual-based accounting lies, which gives you the true correlation and the COGS figures.
So Mani, as an accounting pro that works with fashion brands, what tech stack would you recommend for these organizations to get to the level of financial visibility that they need to achieve success?
So let's start with the procurement and the supply side, essentially. And one of the ones which we are using with most of our brands is called Zedonk, Zetonk. And that's primarily designed for fashion designers because it allows for styles, seasons, collections, wholesale production runs, all of that. So Zedonk is our primary, essentially, supplier side or procurement and management IMS sort of tool. There are other tools in Seven Core and other IMSs which we also use. Depends on the requirements of the client. And then we've got the accounting side, which is primarily we use Xero and QuickBooks, and we also use Sage and NetSuite with some of our clients. And then we come into the sales side of things, which is the integration with the commerce platforms and the marketplaces, which essentially we tell our clients we don't do anything without A2X. Essentially, that's otherwise, we can't give them the clarity thereafter, as A2X allows us to break it down into that whole lump sum which they see coming into the bank account, and A2X allows us to give that summary to them, which essentially is another light bulb moment for them. So generally, this is our tech stack. Obviously, we've got Power BI and other reporting tools as well. Again, it's a case by case on what the client's requirements are.
Awesome. So it sounds like the must-haves are an inventory management solution, like Zedonk or Sin7, as you mentioned. There's the general ledger, Xero and QuickBooks seem like your go-to. And then there's the payout reconciliation technology, which A2X is,
A2X is obviously the gold standard.
Obviously biasly with all my A2X stuff and this being an A2X video, but it is pretty good, I promise.
It's Geoff, to be honest, we in our engagement letters on our with our clients, essentially we have explicitly written we will not be servicing you if you don't use A2X. We trust the solution so much that we typically go like A2X allows us, because that allows us to free up the time so that we can advise them to grow. So that's the whole key.
Love it. Well, you're making me blush, but so we got the accrual-based accounting, right? Which is the methodology that helps you get to financial visibility. We have the tech stack, and you've got the process. I'm really curious to hear, like, what parts of the process here to get that to those accurate financials that give you the cash flow visibility and allow you to appropriately plan for inventory. What parts of the process does ZonKeeper own versus your clients?
Very good question. So, in short, it can be everything or some things. So let me elaborate on that one. So what I mean is essentially we can provide them with the inventory management system support, on procurement, on the purchase ordering side, stock takes, the whole inventory cycle runs, all the way to the accounting integrations, implementation of A2X, all the way reconciliations into the accounting system to Xero, and then providing them with the BI reports essentially, or monthly management reports. So the whole gig from start to finish. Or it can be, if they want us to take over just the integration side of things and the reconciliation, accounting, and the tax, that can be it as well. So it really depends. It's a case by case scenario.
So Mani, that's a great overview. You have been mentioning inventory management solutions, but in many of the fashion brands that we work with, we notice that they're managing their inventory using a spreadsheet. Some of them obviously are using an inventory management solution. But in your opinion, what's that inflection point when you graduate off of a spreadsheet and into an inventory management solution?
At the inception, essentially, when the business starts, obviously the cash flow is tight, and it's use bootstrapping, or it makes sense to have that spreadsheet or Google, Excel or Google sheet, and having your stock, tracked over there. But very soon, and the pivot point I would say is when it comes to landed costs. When you start expanding into multiple different locations with multiple different landed costs, with different quantity being ordered for each location. And then when you are trying to reconcile the balance sheet to the stock on hand, essentially what you actually truly have from your stock take, and it's out by crazy amount, that's the point you probably needed at the IMS maybe a few months ago. So that's I would do, and that's generally when businesses come to us that I have no idea how much stock I've got where, and how much is it costing me in storage, and how much do I need in, for example, in EU, how much do I need in EU, and how much do I need in US?
Totally makes sense.
Okay, so once you have an automated and accurate bookkeeping system that is in place, how would you recommend fashion brands or your clients to use it to their advantage and get insights that will help them make better decisions and potentially even free up cash flow into the future?
Absolutely. With most of our fashion brands, we make sure we have catch ups with them. Some of them fortnightly, some of them monthly, some of them quarterly, and that they're set for cash flow planning, forecasting, and planning. With some of them, we also go through inventory optimization on how what needs to go, what needs to stay. The data-driven reporting, essentially, now using with AI, some of the AI tools, the pricing strategies, we adjust those. We also help a lot of our clients with supplier negotiations, especially in the last few, when there was a change in tariffs and such, tariff changes. We were helping our clients with negotiation with suppliers, and then we can also it depends on the marketing and the collection planning tools can be also used. And then finally, I would say also a good idea to have some sort of funding available to you in case you need in a situation where you need to act fast.
I'd love if you could to potentially drill into what cash flow forecasting and planning looks like in practice for you and your clients.
As you know, once you've got the accruals basis of accounting, you've got the bookkeeping sorted, you've got the accounting, you've got the up-to-date data, it's all happening. But what do you do with that data? Now's the time to look into that data and get some meaningful insights, right? And with the cash flow planning, or what I would do is essentially with our clients, for example, we would ask them what season are they getting in and what sort of collections. Now, these are some of the terminologies which are specifically in, used in fashion industry, and we look at what sort of demand, what's the demand of, say, pre-order. What are we looking at, releasing a pre-order for a season, for a collection, essentially. Once you've done that, we'll identify, okay, how much cash have we got? When is the cash coming? What's our cash outlay period? What is cash incoming period? Work out if there's a gap, then we can, work out a line of credit or some sort of, funding solution to just fund that gap period. And then forecast our cash conversion cycle for that collection. And then from there, once you work that out, we can then go to the supplier and work out some payment terms. You see how the bookkeeping and accounting side has actually taken us all the way to the payment negotiation side. So, and the reason for that, and we do all of this is just to avoid the last minute cash crunch or missing supply payments, and to keep production essentially and the whole marketing and the ad spend, everything running smoothly.
Yeah, and I think what becomes evidently clear, and to your earlier point, like everything that you just discussed assumes that you have accurate accrual-based bookkeeping
100%,
in place,
100%.
and without it, it would be impossible. So like this relationship between cash flow and inventory, I think what we're getting to is that like there is no relationship if you have no visibility. The only way in which you can get visibility is if you have appropriate accrual accounting, right? So
correct.
I think that's a really great point to just kind of close what you were saying, is like it's all connected. It's all kind of like it takes you from kind of soup to nuts.
It also leads you to how you can then, because you've got the visibility, you can now optimize your inventory. Optimizing inventory essentially means, it's a lot to it, but in general, in summary form, I would say, you find out your fast-moving products, your sell-through rates, and then you also find out what are the slow-moving items. Now, again, a very case-by-case basis, but what you then do is you plan your reorders smartly based on the data which you have got. So essentially for the fast sellers, you save your cash for the fast sellers, essentially. And with the slow movers now, you can either decide if you want to discount and just not reorder, or have a low reorder quantity or a lower reorder quantity. And then you can adjust the reorder points in your software that they only trigger at a lower level, don't get added to a purchase order automatically. These things, the optimization or the strategies can be put in place, and then again, it gives you more time back to do. This is a cycle. This never stops, right? It's just a matter of optimizing it, monitoring it. It's a yeah. So that allows you to, so these two go hand in hand, essentially. Again, goes back to the data, good outcome.
Okay, Mani, I appreciate kind of the high level conceptual insights into the relationship between cash flow and inventory, but it would be awesome if we jumped into a practical example on what your approach would be. So I'm about to lob one over the fence. Good to go?
Let's do it.
Let's do it. Okay. So I have an online fashion brand. I've been in business for 3 years, and I'm gearing up for Black Friday. To hit my sales goals, I'm going to have to wire a 30% deposit on a really large inventory order right now. I need to pay the balance in freight in October, and I'm going to lock in a big ad spend that bills weeks before shoppers' payments land. I'm unsure whether my cash can stretch that far. So that's the concept. If you were advising a brand like mine, how do you help me figure out if I can safely fund all of these upfront costs? And then what steps would you recommend if the numbers don't add up?
First thing I would do, a forward-looking cash flow forecast. I would even go to a weekly levels, and that'll be step number one. So we'll work back essentially, and we'll start with cash inflows, expected cash inflows. Okay, and that'll be, I guess you said three. It's been, if it's in business for 3 years, that gives us enough, a really good amount of information to see what's the growth levels, what's the general, the marketplace trends. Essentially, what's the industry growth levels and the business growth levels, obviously. And once you've got that data, we'll start building the cash inflows, as I said. So we work back, and moving forward from that, we will now build the cash outflows. Now, the cash outflows we already know. The first one being the 30% inventory deposit, 70% down the track for the freight and balance of the goods. Let's not forget the ad spend. Ad spend, obviously, it starts, at the very outset, essentially, when you place the inventory order or it's a new collection coming out, essentially. So we've got a pre-launch expenses, marketing, ad spend. Obviously, you've got then other ongoing expenses such as marketing softwares, PPC, all of those. So make sure you also take some OPEX into consideration as well. Of course, has to be normalized or, has to be apportioned correctly as well. And as I mentioned earlier, I would go all the way down to week by week analysis and build that cash outlay. So we've got the cash outflows, you've got the cash inflows. Now, this is where many businesses, what they fail to analyze is the what we call it as the crunch point. And that is nothing but the period or the gap where, I hope not, I wouldn't say $0 in the bank, but I would say there'll be less working capital, or there'll be lower levels of working capital, and which is okay to a certain degree, and then we just, as long as it's planned, and that's where we can, and that's why we can act proactively and have some funding solutions in place or line of credit. And once once you're past that essentially deep point, then hopefully, but based on our plans, essentially, the sales will start coming in, the customer payments, and you'll be able to repay if you had to borrow something during that dip. And the next point I would continue to analyze is the cash flow, essentially your cash flow statements, like what's coming in the bank, and then as I said earlier, this is not a set and forget thing. It requires a continuous monitoring. These operations are not a set and forget thing. They require, once you've done the forecast, by the way, I would say, once you've done all this planning and everything else, then you should try to always monitor actual versus planned, essentially, have you tracking as well. Because if you catch that, let's say you find an anomaly somewhere in the plan or the forecast, and if you're able to find it well ahead, like early, you can make some changes. So that's very important. If the numbers, essentially, as I say, numbers don't lie. If it's everything going well, that's great. If not, then you may need to just get in touch with your suppliers, negotiate better payment terms, and maybe at some point also just stop your ad spend, or not stop, reduce your ad spend, or make these changes. Basically, you need to respond to what's happening as well, right? planning is great, but having that continuous monitoring of actual versus the what plan will what keeps you ahead of the game.
And I think one thing that was understated in your answer, and you talked about kind of like, okay, well, if you get into a cash crunch and you might need to look towards lending, like one of the benefits of accrual accounting is having kind of those financials that you could share with potential lenders.
Absolutely.
It makes you more likely to be approved, opens you up to better terms. Like there's
Stronger balance sheet. There's nothing like a strong balance sheet, essentially. Absolutely. Once and you know when we create discounted cash or DCF statement or basically anything for lending for our clients essentially, and the first item which we get asked essentially is please provide balance sheet on accruals basis.
Yeah, I love it. Okay, so putting myself in the shoes of that brand and working with you, you're going to start with cash flow forecasting, the inflows and the outflows. You're going to do it on a weekly basis. You're going to identify potential areas of weakness, potential cash crunches, discuss opportunities such as, lending or better terms with our suppliers, or even potentially discussing reducing ad spend, and really helping me adjust towards kind of the state of the business at that given moment in time. And then I like your point at the end about measuring actuals versus predicted, so that we can get better and better and better over time. So
Great, absolutely.
Mani, I just want to say thank you so much for joining us and sharing your expertise in this video. I think it is now crystal clear the relationship between cash flow and inventory for fashion brands that are selling online. It can quite literally be life and death for many of these small businesses. As you mentioned, it all starts with visibility. If you don't understand your financial position and how your business is performing, it's really hard to make decisions. To get to that financial visibility, you need your accrual-based accounting. Your accounting method is of critical importance. You had mentioned, red flag 0 or 1 is that you're doing cash basis accounting. Accrual basis accounting is the lifeblood for inventory based businesses. Now, it's not easy, but it's not necessarily challenging to get to accrual based accounting, because there's accounting practices like your own, as well as technology that helps you get there. Inventory management solutions, general ledger software, payout reconciliation software. And the cool thing about this is it also helps automate a lot of the process so that you can save a ton of time and actually focus on what matters. And then what I particularly liked, especially as we got into kind of the use case and trying to, create a practical example for how this all comes together, is, this idea of cash flow forecasting, demand planning, inventory optimization. You had mentioned that, when you work with a business, you try to understand what their cash inlays are, what their cash outlays are, and more importantly, when they might run into a cash crunch, and then some of the potential remedies that they can use to get over that crunch and to live for the future. And what I liked about that in particular is, to me, is it screamed that, hey, accounting, which a lot of the times is considered to be a cost center, only about compliance and tax, it's actually really quite strategic. Because if you're telling me where I might run into trouble and how to overcome that trouble, then that to me is a strategic function. And I love how clear that was in the use case that we kind of went over. So, I thought that you shared a ton of insights, really great stuff. Anything that I might be missing before we hop off?
Geoff, to be honest, you have summed it up so well. I'm out of words at this stage. But if I was to summarize again, it would be the first one would be the accrual accounting. Embrace the accrual accounting for all, not just fashion brands, but all inventory businesses. And then your relationship with your e-commerce accountant should be the one of, the mindset that they are it's not a cost center. It's actually, they are the profit drivers. Stay on top of your inventory. That's for sure. That's the heart of the business. So you cannot not stay on top of inventory. And the last one would be automate and integrate as much as you can, because that allows us that gives us the free time to help you grow, essentially. And yeah, that'll be it.
Love that. It's speaking a relationship with your e-commerce accountant. ZonKeepers, link in the description below. Please do reach out. I'm sure they'd be happy to have a chat with you about your organization and your cash flow and inventory and accounting needs. So that's it for us today. Thanks everyone for watching, and we'll see you next time.
Thanks for having me. Thank you.